Is there a perfect buyer out there for me? The answer is yes, there is a perfect buyer. And today we're going to talk exactly about how to identify who that buyer is and how to attract them to your offering. Today, I'm joined by Jeff Jones, the Vice President of Growth and Capital. Jeff, welcome to the show.
Thanks, Tim. Good to be here.
When business owners start thinking about selling their business, they get scared and they say, well, what if I sell to the wrong person? Is this person going to take my business? Is things going to go sideways? Is there a perfect buyer out there? If so, who are they? How do I find them? Who do I start talking to? They have all these questions that come into mind. But my question for you is there a perfect buyer out there for a business owner?
Oftentimes there is. It really depends on what that seller and that business owner is looking for. And that always means first understanding what they want, what you want as a business owner, expectations that are clear. What's the desirable outcome? Are you looking to maximize value? Are you most concerned with preserving legacy, succession planning, taking care of your team, likability and trust with the buyer? The question comes back to that seller and asks, what does a perfect buyer look like for you? And it's very hard to do a deal with a buyer you don't want to do a deal with or like, because you're in control. So I think the first lesson is, as a seller, you need to maintain control, right? And you can through the process. But first understand what you're looking for and why, and then we can kind of start rolling out, okay, what does that look like for you at the end of the day, and how to go to market with it.
Yeah, I always like to play the game of extremes. So if on one end of the extreme, we say there's a perfect buyer and this person is going to give you more than your asking price, and they have, a sales team that's just waiting to take your business and sell more so you can get more on the earn out. They have a wonderful culture, and this is on one end of the extreme. Everything's perfect. It's Disneyland, and you want to go there. On the other end of the spectrum is the complete opposite. You're mentioning you just don't like the person. There's no likability. There's no kumbaya with them. There's none of that. The truth usually lands somewhere in the middle. But if we look at, let's say, 3 components of what makes a really bad buyer, what would you say are those 3 components that you hear or see often?
It's those buyers coming in and promising the world, setting expectations that are far too high and unreasonable, and then going through the process and realizing none of this stuff is true. There's breakdowns in due diligence. There are retrades in the price of the business. They're not doing things they said they were going to do. There's no follow through there. And so that happens often, and that's where things break down. And I think people are misled. That's probably number one gripe or complaint in the market. Number 2, it's, I think, misalignment just generally of expectations. Normally sellers go to market, or at least have or envision that they're worth this, or they have this value, or this is what they mean to the market, or this is how things should go. And they start talking to people and it's not quite there. Expectations fall short. And naturally that discourages you as a seller and as a business owner, especially when you put so much time, money, energy, and your life into something that not everybody else on the outside sees the same way. The third is probably just the human part of it. To your point, we talked about likability. It depends though. Are you forced into a sale? Do you have to do something, or do you not? And I think that the emotional part of it, the kind of humanizing impact, the cultural impact, and all of that, it's very stressful. It's very hard. It's very emotional. It's very distracting. I think that's a big reason too, at the end of the day.
Yeah. So let's go backwards a little bit and talk about likability factor. We spend a lot of time with these potential acquirers going through the process.
Indeed.
Maybe it takes 6 months, 9 months, 12 months. You're spending a lot of time with them, and you're going to get a really good sense of who this person is.
Yes.
He's like, how early should you judge the warm and fuzzies in the process? If you meet someone, you're like, hey, this guy sounds great.
Yeah. I mean, listen, at the end of the day, if someone's looking to acquire a business, they are selling, right? They are selling you on a number or a growth vision for the company or the future. And yes, of course. So naturally, if they're good, and most of them are, whether they're professional or other operators, they know what they're doing. So I think the warm and fuzzies are important initially. Good rapport building. You want to like the person. I always tell clients, listen, could you go have a beer with these guys? Could you sit down and have a dinner And is there common ground? So I think the key is get away from the business initially and get to know one another and feel like there's alignment there. And that could just be talking about family, it could be talking about places you like to go, it could be just general philosophies in life and business. And I think that is key. But yeah, I mean, over the first few conversations, naturally, if they're professional buyers, they're going to come in with a line of questioning and an approach and philosophy that works, but they're going to be all business. So it's sometimes hard to differentiate or try to, I guess, compartmentalize that discussion for the seller. And it's up really to you to push that back. So again, as an advisor for us, that's part of our job. It's to, not fully commit to the business conversation until, maybe there's at least common ground and likability and a philosophy that might sync up, which is just as important as the technical and fundamental side of the business.
Common ground, you mentioned common ground, and people that operate in your space that have a deep knowledge of your space, it's easier sometimes to find common ground with them because you have vernacular, terminology,
Yeah.
percentages, all these different things. But what about the buyer who doesn't come from that industry per se? How do you build common ground with this person?
Yeah. So we're talking about companies that are competitors or in your space. We call those strategic, operating businesses that do know the space. So it makes the conversation maybe a little bit easier. But there's also some risk to that as well, from a competitive perspective. But yeah, going back to the non-strategic buyer, the likability factor maybe is actually less important for some people. The reason being is if they know they're talking to a pure financial buyer like a private equity fund, that they are normally shooting for kind of maximize value approach. And you get into those conversations and you start to realize that you're not necessarily going to have control of this thing going forward, and you're trying to do a transaction with a group that does transactions for a living. And so the likability factor, of course, is important. You want to feel like you trust that party, that they're going to take good care of what you built, and they're going to do what they say they're going to do. But everyone is a bit more transactionally motivated. So I think the expectations, Tim, around the likability maybe soften a tad, if that makes sense, right? Because everyone knows coming into that conversation that they're trying to get a deal done.
Right.
The strategic buyer is a little different sometimes with different motivations. The financial buyer is everybody comes to the table knowing that, okay, we're going to talk about the business. We're trying to understand if there's a deal here. Does it make sense for everybody and move forward? So it is important. I will say the financial buyers maybe have a reputation that isn't as strong as maybe the strategic angle, but that's what they do. And so as clients, as advisors, we prepare the clients for that type of interaction. Understanding the profile of your buyer is extremely important before you have these conversations, and knowing, again, what to expect. Not everyone is going to come in selling you hard and, to your point, trying to create a Disneyland scenario.
Right.
Some of these financial buyers are just looking to get deals done and make money. And so that's an approach you have to understand.
Yeah, and you mentioned at the top that one of the areas where things fall apart is in due diligence. How do things fall apart in due diligence? What should we be looking for when things are falling apart? What are those signs?
Yeah, I think the signs are, as I said earlier, the under promising, over delivering, and vice versa of what those expectations are. And I think the biggest component of our advisory practice when we're working through processes for clients and sellers is understanding what that due diligence expectation is. And so it is robust, it is rigorous, it is distracting, time consuming. And so naturally, a buyer of a business is going to want to de-risk the entire scenario and understand everything about that business, about you, not everything personally, but a lot about you personally. And so sometimes there's a disconnect, sometimes it's very fatiguing. And naturally in that cycle, when you're getting request after request after request with the depth and the rigor behind it, you lose that momentum. And that's one big part of it. I just think there's a natural fatigue during that process where maybe expectations aren't aligned. The second part too is that the breakdowns could come when information isn't readily available, isn't available at all. As a seller, as an entrepreneur, sometimes you're not necessarily running a business in a public forum. So getting the financials clean, getting the house in order. That hasn't been done yet. So naturally, there's going to be kind of an uncomfortable feeling when you're just opening everything up to say, okay, we're going to give our most secret and discreet information here, or our IP, or open our financials, or unlock our HR cabinets and say, here you go. That's a very uncomfortable feeling. So naturally, there's going to be sometimes a breakdown there as well. Now, that doesn't mean you lose the perfect buyer, Tim, and doesn't mean that it's the worst buyer ever and the experience is horrible. This is everywhere. Anybody that's going to acquire a company for potentially millions and millions of dollars and make that investment, you have to expect that there's going to be some, deep digging, as we like to say, going through that process. So again, it's just understanding and being prepared for the market, which is most important.
So when that process starts to fall apart from a buyer who is, let's say, is less than satisfactory,
Yeah.
what does it look like? Let's say I'm the entrepreneur who's interested in selling my business, and you are the buyer who's coming to do due diligence. And we're kind of filling each other out, and you're making certain promises and maybe not delivering. And we get into this due diligence process. And let's say I'm buttoned up on my end with my business. I have a time, but let's say things are falling apart on your end. What does it look like when it falls apart from the buyer side?
From the buyer side, it's a couple things. I think I'll go back to what I said earlier. From time to time, you understand buyers are oftentimes busy looking at a variety of opportunities. Okay. And sometimes bandwidth constraints will slow the process down. Sometimes distraction will slow the process down, and also lack of customization. So if I'm a buyer, the breakdown oftentimes comes when we're sending due diligence checklists and expect the seller to do this and that, but it's not necessarily customized to that situation or that company. That can get lost in translation. Also, oftentimes buyers will bring in third-party due diligence firms to help with review of financials or technology, or staff, HR, those kinds of things. And there's a disconnect there as well. And so the buyer just expects things to go a certain way. When it doesn't, they're potentially, again, not just misalignment, but the attitude towards deals change, priorities change. I'm spending money as the buyer and taking time with my team, with those outside parties helping with due diligence, and I'm not getting what I want. If there is a disconnect, that creates bad energy in the deal. You lose momentum on both side, buyer and seller side, and the likelihood of that deal breaking down becomes exponentially higher.
In order to find a perfect buyer, do I need to be a perfect seller?
Well, no, of course not. I think, again, that with any business we've ever worked with, there's always some gaps or some flaws or skeletons in the closet or whatever it might be, but there's no perfect, right? At the end of the day, everyone has to settle on something. And again, it's all about expectations. But no, as a seller, it's impossible to be perfect because you just don't know exactly what each buyer is going to. Now, generally speaking, we can advise you to know 70-75% of what everyone's going to want to see. But depending on the buyer set and what they know about the space and the business and what they want to do going forward, there's going to be different requests that you may or may not be able to fulfill. And so, you try to set an expectation of perfection, and it's not going to work.
Right. But there are a few themes here, and it sounds like the sellers can do a few things to get themselves well prepared before they hit the. More commonly, what happens, we see somebody who says, I've been approached, and there's an interest now, and I'm trying to capture that interest. We have a little lightning in a bottle. So let me scramble, because I don't operate a business in a public forum. I don't have all my materials nice and tidy, and they just start scrambling, and now they're in a bit of chaos because they're concerned about this deal falling apart. Maybe not even a real deal, there's some initial interest. What would you say to that person in that moment?
First step is slow down, take a beat, like you said. Take a breath. I will tell most people this, that if someone's interested in acquiring you now, they will be interested in acquiring you in 6 months, in 2 years, and beyond, right? And just establishing that relationship and getting on their radar, that's important. But trying to scramble to satisfy the requests of one buyer, that could work, but that's not necessarily in your best interest. So you continue to have that conversation and simultaneously try to understand what's required to satisfy that request. But also, generally speaking, if I do think about broadening my process or search to other suitors in the space or in the market, how does that impact this as well? So yes, that happens all the time, especially these days where a good quality operating company that might have shown interest in the past or may look to exit, they're already getting calls, whether it's a competitor or someone in your category, whether it's a private equity fund, for example. Most owners are somewhat sophisticated and savvy and somewhat informed to know that they get these calls often and not to necessarily overreact to just one. But there are ways to play the game to extract more knowledge and information from that interested party to benefit you, right?
Yes.
It's not just you have to, there's a lot of other people to dance, right? And so the opportunity there is to reverse course, do some of your due diligence, get informed, learn along the way, and understand things that maybe insights or things you're looking for that you didn't know ahead of time or in advance of that. And so take advantage of those situations as well, and learn for yourself. And there are ways to get some information to these folks and push them to get at least some indication maybe of what they're looking to offer, right, in the form of an indication of interest or LOI. And so you don't have to necessarily go deep down the rabbit hole of due diligence, but there are definitely tricks of the trade and ways to extract that information out of that potential interested party and buyer to get really informed on whether or not it's worthwhile to continue.
What would some of those tricks of the trade be?
The advantage of hiring an investment banker and advisor in this process is to simply the fact that you've done so when you're talking to somebody that might be interested, that kind of sparks interest. If I'm an entrepreneur, I let people know that, yeah, I get calls from time to time. And yes, I have an advisor. And so from that point on, that buyer normally, realizes, okay, they have somebody on their end that understands this business and knows what they're doing. And so I better probably be a straight shooter here and get to the point and determine if it's worth our time to continue the conversation, right? It's preparing enough information for that potential buyer without disclosing too much, if that makes sense. So high level information, like I said, getting into the conversation with them, making sure they understand the industry and the business, what's their strategy going forward, and really getting into the kind of that, that back and forth that is very productive. And also sell yourself. If you get people excited enough, right, and they're really interested and the timing seems to be right, then you can, you go down that process, they get excited and they're willing to potentially, show their hand as well. So those few things, kind of hopefully accelerate the conversation, be much more efficient with your time.
Yeah. When it comes to getting your house in order,
Yeah.
what would you say would be like 3 or 4 pillars of just good old fashioned house in order from the seller side?
Number one, prepare early. Go through all these steps to understand the market, what your end game is, and then work towards that, right? So preparing early means running your business as if someone from the outside is evaluating it, right? Definitely financials, clean financials, the number one culprit for tricky due diligence, deals falling out, not maximizing value, is get your financials reviewed. If you have a CPA, get them officially reviewed, not necessarily audited. That's fine. That's great. But have another set of eyes on those financials, make them buyer credible and market credible and clean, and then work on your forecasting. So anything financially related, or if someone asks for the last 3 years of your P&L, balance sheet, and cash flow, it's in an Excel model. It's ready to go and deliver. And then look at the next 1 to 2 years of forecasting for the business and have a budget that is, something you can meet, but also is exciting, right? That's pillar one. Pillar two is looking at your internal infrastructure. Okay. The standard operating procedures, have a systematic business, right? Everyone kind of knows what they're doing. It operates cleanly every day. And you're not the person that is most essential to it as the owner, operator, or founder of that business. So you need to promote a business and be able to, should demonstrate that. I'll use your line, Tim, right? If you get hit by a bus tomorrow, right? Can that business continue down its path as if nothing ever happened? Obviously, to a certain extent, that's impossible. But showing that buyer that the business handed off to another party, other strategic partner, is in good hands going forward. Okay, pillar number two, it's kind of the infrastructure, clean operations, not being so essential to the business, and be able to showcase that. Pillar three is show a growth opportunity, right? Someone's buying the company, and whether they are adding on to other portfolio businesses or they're an operating company in the space, they understand things, but they want to know from you. And by the way, this is how you should be operating your business, regardless of any outside interest in acquisition, is rolling through your growth plan for the next 2 to 3 years, at least twice a year, minimum once a year, but having that good sense of where we're going as a company and having that roadmap, whether it be growth in market share or product pipeline or technology or team or competitive advantages. Where are we going? How are we investing in this company to go 1, 2, 3x over the next few years? And having that good sense will get the market extremely excited, right? When you have conviction over where the business is going, and that's going to help everything else we've discussed kind of fall into place.
What does it do for a company when they have all this in place?
Go back to number one priority for most people, maximizing value. So you show growth opportunity, you show a clean business, you mitigate risk, you de-risk a business opportunity for a buyer or an investor, right? That's going to help you maximize value, number one. Number two, going back to this due diligence issue, it's going to help accelerate a process that is a bit more clean. It's much more advantageous for a seller to not sell quickly, but not have that process drag on. Oftentimes, buyers will delay and extend their exclusivity or due diligence process to, whether it's not understanding something or continue to try to unturn something, not having information. The cleaner you are with these pillars in place, the more efficient that process is going to be, and much more likely that whatever deal they've proposed or you have a term sheet or LOI for actually gets done at those terms. Okay. And so all that's easier. Also, having these pillars in place, Tim, allows you to talk to multiple parties simultaneously with not having to make customized or satisfy customized requests all over the market, right? You have this ready to go. You're consistent in your message. You're confident in how the business is going to be evaluated. And you can talk to a variety of parties without being overly distracted or consuming your time.
Yeah. Peace of mind, sleeping better at night, feeling more confident. You will probably improve the nature of your business by having good standard operating procedures, good budgets, having everything dialed. What about employees, talents, golden handcuffs, lockups, things of that nature?
Yeah. So I think, again, depending on the buyer, strategic buyers don't prioritize the talent or the employees as much as financial buyers. The financial buyers are going to need that team to continue to execute and operate on a day-to-day basis. Whereas the strategic, sometimes you get absorbed, sometimes not, depends. Very, very important. Whether you're running a business or doing deals, it's all about people. And so that all has to come into play. It is a big deal in due diligence. Locking these people down, it depends. I think first and foremost, you need to understand how discreet you need to be with your team and how informed they need to be going forward if they're involved or not involved. I think you need to start planning that ahead of time. Who are those key people and those key drivers of the business that for sure, no matter what kind of buyer comes in, they're going to want to retain. And so those people, when you have those conversations, there are ways to say, listen, we'll incentivize you to help us get this deal done, whether it's money or continuity of employment or a seat at the table going forward, right? Or even handing the reins to that second tier management team, for example, right? So there are ways to do that to inform the people that are the key contributors where any buyer is going to want to want to definitely retain. And then, of course, you have your rank and file, if you will, and you want to take care of those people as well. You don't want just all of a sudden, 1 month everyone's employed and happy, and 6 months later you're selling the company and they're out in the street. 100% of our clients care about their people and their team and their staff, and there's ways to take care of them through the transaction and beyond, whether it's negotiated in the deal, whether there's some kind of distribution post sale that you can contribute to your team so they can give a bridge to their next job or their next career, whatever that might be. But that is always high in priority list. Buyer perspective, talent is everything. Seller perspective, hey, we built something together. We're a family here. Let's make sure we take care of it. And it's totally possible. No one gets wiped out if you prepare ahead of time and you go about your business the right way.
So finding the perfect buyer requires a process. This is not a one-time event. It is almost a marathon in some regards. What is a process? What should the audience know about running a process, an official process? What does it take to go through that? And how does that lead to finding a great buyer?
Yeah, absolutely. So finding a perfect buyer, going back to your theme here, is everything revolves around the process. You don't just talk to one party. So I'm going to go high level back to what I was saying earlier around first, you have to understand what the end game is for you. Okay, that's critically important. It's part of the process so we can align expectations. Second, you got to get informed on what types of buyers are in the market to actually identify and evaluate the perfect buyer. Okay. Third, get informed around your space and know what's going on. Know what's going on out there. Who's raising money? Who's getting acquired? Who's competitively brilliant? Who's not? Right? Understand where you fit in that dynamic of the market, right? And then prepare for market, as I was saying earlier. Get your house in order, create a good story, and then actually go to market and talk to various groups and businesses. And that's the process. It's preparing for market. It's telling a great story. It's being confident that when someone is critiquing your business and evaluating your information and getting behind the closed doors, that you're confident in what you're saying is true, it's verifiable, and it's attractive, right? Those things. And then you run a process to talk to various groups, different types of buyer profiles, right? You're not going to marry the first girl you date, kind of thing, right? It's you have to understand what's going on, talk to various perspectives and people, and then be able to leverage one conversation against another to truly identify the best fit out there in the market. Okay. And that takes time. And you run a process to do that. You find the best fit, you maximize value, right? Everything kind of comes, is aligned and comes together. And from there, you go through the process of getting to know each other, due diligence, and hopefully getting it closed. So, that those core steps are the key to finding a perfect buyer. I think if you remove any one of those elements, it could potentially be problematic.
So when should someone reach out to you and growthink about running a process? At what point?
I mean, listen, now, whether you're selling whether you have a mandate to exit your company or create liquidity this year, next year, or 10 years from now, I think one point I'm trying to make in this conversation is it's never too early to think about the end game and prepare, right? Those who are prepared are the ones that actually have successful and positive outcomes, right? And so you should always be thinking about the end game, right? You should always be building a business to sell. And if you don't sell, and if you never wanted to sell and it's a lifestyle company, fine. Building that business to sell creates a stronger business in and of itself, right? Those are the guidelines to build something of value over time. And again, whether or not that transaction actually takes place. So those conversations, and I've had 3 conversations this week where they're 2 to 3 years out and they wanted to understand what steps they should take to get there to maximize value. Conversations where, hey, I have a 6-month mandate. How can you help? Right. Mm-hmm. So you kind of take a step back, reverse course, say, have you done these things? So it's never too early, never too late.
Okay. Let me ask you one last question. And this is about building enterprise value. So the CEO's job is to always build enterprise value. And sometimes entrepreneur CEOs kind of let off the gas a little bit when they start getting into some of these conversations. What is your advice to these folks?
Yeah, I think the number one thing all of our clients can do to help us and help the process in terms of maximizing value is to continue to perform at a high level. If you let the foot off the gas, and it's understandable because we're stressed, it's emotional, you're distracted at times, obviously, bandwidth constraints when you're trying to also run a deal. That's why you have an advisor to absorb some of that for you. But your job as the entrepreneur, as the business owner, all these other things we've been talking about is to continue down your path and don't see the blip, don't see the plateau, don't take your foot off the gas. Because if I show the market, if you're my client and I'm able to communicate in the market a business that continues to grow or continues to hit milestones or continue down the strong path you've been on historically, I'll show you a deal that gets closed at a valuation and a fit that everyone is satisfied with. That is the key, because you create momentum in the market. Those buyers see that you have something special, that you continue to perform, that in their mind says, man, it's a FOMO effect to say, I better get in now versus later. And there's a premium to this because it's consistent, there's continuity, it's some predictable-ness of the business. That's key. So continue to perform, continue to show growth if possible, and keep the foot on the gas. Very, very important.
Yeah, pedal to the metal. So if you're out there in the audience and you're considering selling your business, it is never too early to get into the process. So we will put our contact information down below. Please follow, like, and subscribe. And thanks for joining. Thanks, Jeff.
Thank you.